Good morning, everyone. I'm Gary Stifler, Director of MB Growth and Development for GD Council. And thanks for popping in here today. What we're going to do today, a little bit on the format, so we're going to talk about capital access, and I have three folks here. I'll let them introduce themselves here in a minute. But our goal here today is to have them cover a few areas. And some questions I'll ask them, but then really after about 20 minutes, I really want to turn it over to the MBEs here and folks in the room. And what are some of the challenging questions that you have and when you're trying to access any kind of capital? And this goes from a standpoint of any size you are. I mean, we've got a range of companies in here, from smaller companies, startups, to larger firms. And the need for capital and how you go about getting it is different sometimes in those different ranges. So with that said, I want to turn it over here to Brendan, let you open up and introduce yourself and who you're with, and we'll get started.
Thank you, Gary. My name is Brandon Pettigrew. I represent Stonehenge Capital. Stonehenge, we've been around for about 25 years, national firm, but we're a boutique private investment group, a non-bank organization. We're impact investors. We have a series of funds that we use to get capital to minorities, women, veterans, but we also have a place-based strategy as well, meaning we focus on companies that are located in areas targeted for revitalization, areas where there's low income, and the whole purpose behind that is we feel that when you allocate capital in those areas, number one, those are areas that capital is typically not chasing. And it tends to be in areas where minorities and women and veterans are located. And then secondly, those asset prices tend to be a little less, so it tends to be more attractive. And the whole point is to bring those areas up so that the poverty and the unemployment rises as a result of us investing in those companies as they're employing people in those areas. We kind of sit at this crossroads of economic development and finance. That's who we are.
Excellent. Thank you. Stephanie?
Good morning, everybody. My name is Stephanie Martin, and I work for Bank of America. In my role and what I do is, Bank of America stems from the startup business all the way up to the large corporate franchise businesses. In our business banking department, we work with about 4 different tiers of business bankers out there, stemming from your startups up to about 5 million, and then your middle market from 5 million to 10, and then we go up from there. So regardless of where you are in your business venture, in your business journey, and thinking about business capital, we do have a line of business, including ample amount of partners that we do work with to really help you adjust your profitability.
Thank you.
Good morning, everybody. Carl Duguerre, and I work for Citizens Bank. A little about me: 16 years in banking, and at Citizens, I think when everyone thinks about business, they're thinking at the branch level. So I'm a business market manager where I work with a team of experts that are tailored and dedicated and stacked, right for our small business population. And similar to Stephanie, we start from startup and all the way up to large size corporation, where it's a dedicated expert that's here to, certainly hear concerns, address your needs, to think about solutions that's going to help meet and exceed your expectations from a needs perspective.
Okay, so I guess the first question will kick off. There's all types of different loan mechanisms that you go through. What are the ones that you probably see the most right now coming from small business owners? And what is the first, kind of ask, so to speak, that they come to you with?
I'll take that one. Everyone always comes in and says, I need a business line of credit. And a lot of times those are most of the loans that they don't need. It's a different type of loan that is needed. I think that's probably the most talked about loan is a line of credit because it's flexible. So you use it, it's like a home equity. So you use it when you need it and you put the money back, and it just allows you to put money in and out. But in most banks, there's so many different types of term loans, I would say, in different types of, line of credits out there. It really depends on the need, and the purpose is how we align it to ensure that it's a right fit for our client.
Okay, thank you. Anybody else want to?
Yeah, I'll take that as well. I agree. I mean, it obviously depends on the need and the purpose. Sometimes, frankly, it may not even be a loan. You know, you may need some equity. You know, you may not have enough cash flow to support the debt payments, right? And so that's always something to keep in mind is, you know, when you're going to a capital provider, try to do your research and try to understand, you know, number one, what that capital provider provides, but also, you know, what are your needs? And as a capital provider, we provide debt, but also equity as well. You know, obviously equity is you're giving up ownership. And, you know, I've always, you know, told a lot of the business owners I've consulted with over the years, 100% of nothing is better than, you know, giving up 15, 20, 30% of something that's meaningful, right? So just understand the you know, the pros and the cons of being able to give up a little ownership so that you can get partnership with a group or with individuals who can really help take your business to the next level.
Yeah, just to correct, I think you meant the other way around. I mean, have 100% of nothing is
right.
nothing. But if you give up 10 or 15%,
Right.
I had to do that with my business, right? Give up, still kept the majority share, but give up a piece. Because if you're going to grow the business, that percentage is worth more
Right.
than 100% of a dollar, right? So, all right, thanks.
Yes, and I would agree. I think the business line of credit tends to be the most asked about or demand. You know, you figure, given the fact that there is no payment unless you draw it down. So typically, I think a business owner will come in, and that might be the first thing that comes to mind. But once again, it really comes down to purpose and need. Because a lot of times, line of credit is really for short term. So initially, if it's a long term capital expenditure that's being proposed, it might not be the right solution. So certainly, we go through a assessment to really identify, you know, what is the purpose and what may be the best solution that's going to fit that need.
Great. So one of the things, I know we mentor a number of MBEs that are looking to access capital from credit lines to equity to what have you. And one of the things we preach upon is, you know, their financial statements and documentation. So I'm going to pose the question here. When you receive information from the MBE, what is the most important pieces that you're looking for as the documentation, right? What are you looking for from pretty much any type of loan or credit line that requires you to help take the next step and evaluate it? What are some of those items?
Well, I'll start with us. So typically our funds, we support a great number of businesses who are seeking to do acquisitions, right? I probably say 80-90% of our funds go to that. You know, we obviously are looking to support just growth opportunities with existing businesses as well, that are organic. But when it comes to acquisitions, a couple of things here. We operate from the perspective of when you're going in and you're looking at these opportunities, you know, the financials have to be in order. Your financials and the financials of the target as well. And what we have, you know, what we do is, you know, we have what is called a Q of E completed, which is a quality of earnings. This is, you know, a document or performance procedure that's done by accountants on your behalf that, you know, documents and shows that the company is performing at the level that you think it is. Because we're cash flow lenders, we underwrite on cash flow or EBITDA. And so we want to make sure that, you know, if we're going to underwrite a loan to you, that there's enough EBITDA there to support the loan that we're doing. So, and typically all of our loans, when we provide them, there's an expectation that you will have audited financials moving forward. So for us, there's no ifs, ands, buts. You're going to have audit financials if you bank with us at some point. But, you know, depending on where you are in that phase, you know, it may take a year, it may take 2 years, but you will have audited financials eventually if you do bank with us.
So before you two try to answer this, that's a very good point. And then one of the things we talk to our MDEs about is sometimes at least the initial documentation that a minimally a review should be looked at, correct? Maybe not, because audits are expensive. Let's be straight up here. Audits are cheap, right? So if you're a small business owner to do an audit, question, But a review, when you're doing your tax, getting ready for your taxes, to have your CPA do a review, that's a very key point. And if you can have back history in those reviews, that's going to be very important on the initial documentation. Like if you go with Brandon's company, going forward, you're going to have to do audits, and you have to understand that. It should be a positive because you've hopefully gotten a lot of money from Brandon, so you're growing your business. So that's the other side. So go ahead, Stephanie.
Sure. And you bring up a great point, because a lot of what we ask our clients is, who is your accountant and who are you working with? That's always really, and we still to today come across where they try to do it on their own. And it's super important to, when you think about investing in your business, is investing in you as the owner, and invest in actually having a quality accountant that you can build that trust with, because that accountant's really there to help your business grow at the same time, as well as stay away from certain tax litigation. So your accountant is also, when it comes to the lending piece, we like to work closely with your accountant. As the business owner, you're out running a business. So it's a lot easier for us to work closely with that accountant, because primary things that are needed, depending on the size of the loan. So of course, the bigger you go, the more is going to be needed. Let's just think, if you do a simple auto loan, there isn't anything that's really needed for that. It's just, what is the car, and the dealer you're looking to buy from. But if you're looking to do like a loan, maybe even up to $50,000, there's sometimes no information that is needed, just kind of verifying that you are a legal existence of a business. But as we get larger, then it's normally, 2 years of personal tax returns, could be bank statements, definitely 2 years of business tax returns, profit and loss statements, quarterly statements, and things like that, tend to be more involved, which that's what our accountants are for, and build all of that, and they usually have at their fingertips for you to provide.
One of the things I caution a lot of MBEs is Stephanie's pointing out all these reasons for the information. You could have the greatest opportunity, whether it's an acquisition or a new product you're producing, and for you, it's the next thing, it's going to be the greatest things coming out. You can't understand why somebody won't loan you money to tackle this. You have to remember, these folks are concerned about one thing: can you pay them back? That's all they're concerned about. So, the marketing and sales approach is great. You got to have your act together and know that. But remember, what they're looking at is financials, looking at spreadsheets, looking at cash flow statements, making sure that you can pay them back. And the more latitude you have in being able to do that, the greater opportunity you can to take that loan. Carl, if you want to touch on the same question.
Sure. To that, I definitely want to echo the significance as a small business owner, to partner up with an accountant versus a tax preparer. And I'll be vulnerable and say that I made that mishap as well too. So I'm a small business owner along with my wife in real estate, and for the longest time we were just using a tax preparer until things starts to grow beyond what you notice, like, oh, this doesn't seem right. And I would encourage all small business owners, have a conversation with a bank. A bank should be a partner as well too. And do that, you'll certainly see the value of partnering up with an accountant. If it's someone that certainly specializes in business, even better. Because yes, for us, as we're looking at a loan request, we're looking at historical, right? So this is the past 2 years for business, 1 year personal, not necessarily the future, but we're looking at the historical to certainly assess to see the capability of being able to pay us back. And that's certainly a key component as us assessing, a loan request.
Yeah, I know. I was talking personally as a business owner when I acquired my businesses back in 2005. The most important hire I made, and the first hire I made, was my CFO. Flat out, no questions asked. Because that's the person that has to come in sometimes and tell you what you don't want to hear, but to telling you straight up of what you need to hear. So again, the accounting side of this is very important. So we talked about the loans here a little bit and types of loans you can access. One of the questions we get from MBAs quite a bit, because a lot of folks are like, I don't want to go in debt, right? Because I don't want to have to put a personal guarantee up. I don't want to have to have collateral. What is typically the thresholds at which you look at borrowing where you need to have certain collateral or guarantees as part of that loan?
I'll start that off. So at Stonehenge, we are a non-bank. We're institutional investors. Typically, we're probably the first institutional money that goes into a business that we invest in. We typically do not ask for personal guarantees. Most of our money or structure is non-recourse. However, there are certain situations where we do ask for that. So for us, we like to have alignment. What does that mean? That means, we want to see skin in the game. We want to make sure that whoever we're partnering with has invested in their business, and especially if they're doing an acquisition, we want them to bring some cash to the table as well, right? So if we feel that there's adequate alignment there where they put in capital that we're comfortable with, then we can proceed with the non-recourse line. Furthermore, in terms of an entry debt to EBITDA multiple that we look at, we're typically in that 2.5 to 3 range, meaning if there's 2 million of EBITDA of the company, let's just say, this is a company you're looking to acquire, then we can provide up to 6 million of debt, right? That's kind of how we look at debt to EBITDA multiples and how much lending a business can support. And, obviously that can fluctuate a little bit depending on the type of business, the quality of the revenue. Is it project-based? Is it, is there a lot of recurring revenue? Companies that have a lot of recurring revenue tend to get a little bit higher debt to EBITDA entry multiple points, but more project construction-based companies tend to have lower multiples just because that revenue is, because it's project-based. You can't bank on it as much, so you want to come in at a lower debt multiple than others. But those are just some of the ways that we look at deals.
Perfect. Carl or Stephanie?
Yeah, we have so many different loan products that it kind of depends on the type of loan of what it is when we think about collateralizing it. We do go with select loans looking at, we do formulas of debt service coverage. So looking at where the liquidity is of the business versus what their debts are, and do a formula to see, depending on the amount and the cash flow, does it make sense? So, funny story, but we did have a new business come in, and it's like, I need $1 million. Okay, well, what are we looking for to do? And it was, well, if I had that $1 million, I could hire more employees. I could, put money into the marketing. I could get a new vehicle. They had a great reason, right, of what that $1 million would really bring to the business. But that business, when you look at from a built capital with liquidity, which is a lot of what we look at, they only had about $1,500. So it's very, the 1,500 versus the $1 million to give them, it doesn't, help them through understanding. And this is where we as banks have got to, we scale back and really understand their priorities and how their money comes in and how it goes out to ensure that we have a faster life cycle to help them with those receivables coming in. So eventually get them to a time where maybe they can build out and do a loan for $1 million, $1 million.
And what I'll add to that, Citizens, the revenue can dictate as well too. So if, the loan request, if it's over 250, we will certainly would need to look at collateral that's going to support that debt. And collateral could be your receivables, it could be inventory, or it could be real estate if it's an acquisition that you're purchasing. Under 250, that's where we do have unsecured product that's available. We partner with the fintech, what allowed us to come up with some unique and creative way for unsecured financing. But for the most part, anything under $1 million will always require a PG with Citizens. Above $1 million, it's a different threshold. But anything under $1 million would require PG and collateral for 250 plus, which would be inventory or receivables.
So I can address the collateral just very quickly. Because we are a non-bank, we kind of sit at a different risk profile than commercial banks.
Yeah.
So what that means for us is, we can take on more risk. We're not as concerned with collateral because we provide cash flow loans. So, many of the loans that we provide, I mean, we might have 10%, 15% collateral coverage, and we're fine with that because that's the risk that we're willing to take because we're not a bank. You know, we're taking on a little bit more riskier loans than, you know, what my counterparts would do. So we're not as concerned. Now, don't get me wrong. If there is collateral, we will take it. But the majority of the loans that we provide have very little collateral coverage. Yeah.
And just to add to, and that's just a conventional, but a lot of times we will have collateral shortfall that comes in, and we're a preferred lender with the SBA. So essentially, this is where we partner with the SBA to mitigate that, to take a look at a request where they might not be sufficient or collateral available, but it's a request over 250 that helps us kind of mitigate that and take a look at that up.
Yeah, I do want to go to that subject actually in a little bit here because a lot of our folks have pursued and should be pursuing SBA loans also. But what I wanted to ask is pause for a second though. There's a lot of terminology being thrown out here. Does anybody need clarification on, you know, guarantees, you know, what skin in the game means, what debt to equity ratio means? Everybody,
Yes.
Go ahead.
EBITDA.
Okay, EBITDA. We'd like to go ahead and take that.
Yeah, EBITDA is earnings before interest, taxes, depreciation, and amortization. So what you're doing is, you know, when you look at your net income, you're adding back some of the non-cash items so you can get a real view of what the cash flow of the company is. So especially if you have real estate or if you have bought a company where there's a lot of, airball, if you will, you have to amortize the actual asset value versus the real price that you paid for it, right? So they amortize that. So that's a non-cash item that's amortized every year. I mean, it's great for you because it reduces your tax liability. So what we do, we add back some of those non-cash items plus any interest that you're paying because we will be coming in, taking over the debt payments. So we want to take out the interest that you pay, the taxes, the depreciation, amortization, so we can get a real number for what the cash flow of that business is generating.
So again, EBITDA is key. I mean, again, a financial person on your team would know when you do a P&L, that's typically where P&Ls will flow down to. Some people look at it as net income, look at it. But EBITDA is what a lot of the institutions will look at because that's true indication of your cash flow. Any other terminology, Claris?
Yeah, I think I heard you say PG. Is that what you were?
Yeah, personal guarantee.
Okay.
Yeah, personal guarantees. I think it's always important because sometimes these guys, and I do too now, because it's second nature, you start flying out terms and people know. Any others?
Gary, I just
Yeah, Ron.
I just wanted to share like a personal anecdote to put things more like a practical, like why would you need funding early stage? So 16 years ago I got laid off, started my company, and bootstrapped it with my severance package. And I think a lot of MBs or small businesses sometimes hold that as a badge of honor, and I did for a long time because I was buying computers used, buying desks used, had a cheap rent. I was really trying to kind of just make that 60K, which was my severance, last as long as I could as I grew my business. And it was through the MBDA that I started learning about the financing options that were out there. And I, like many, I didn't want to lose equity and I didn't want to go into debt. I was trying to keep my expenses as low as possible. But I realized once I started scaling and hiring people, that payroll came every 2 weeks. And guess what? Clients don't pay you every 2 weeks. So the math was a massive for me, and I was getting very stressed out every time payroll came around. I was calling some of the clients that owed me money and found myself doing this repetitively. In between those, because as you grow, you start getting bigger clients. And guess what? The bigger clients take longer to pay. Some of them take 90 days to pay you. And you think you've got this big contract, but your team is not going to wait 90 days to get paid. So that business line of credit was my first kind of foray into the financing that was out there. And the way it worked for me at the time was I was able to get, I think, $120,000 line of credit. I gave like a couple of years of my taxes. Everything checked out. I got approval, and then I paid like $250 a year to have access to that. And it was literally like in my bank account. And if I needed to, I could literally transfer from my phone over to make payroll. And then when the clients paid me, I could transfer it back. And as long as I put it back before, I guess, you guys can correct me, like a month or 30 days, I didn't have to pay any interest on it.
Right.
And I'm telling you, you become such a much better boss when you don't have that stress. Because your energy, if you're a small business, you're the boss, you're also the salesman. And when you have that energy of like, I gotta get paid like this week, it really scares away new business. And it makes your employees feel like, we better find another job. I mean, it's a snowball effect.
Yep.
And I know it's a badge of honor to bootstrap when you're very small. There are a lot of products out there that it doesn't mean you've lost ownership, it doesn't mean you're in debt. It's just using the tools that a lot of the bigger businesses do. And now 16 years later, I'm in a much better position. You know, company's successful, everybody's on 401k, benefits, like things I would never have dreamt of. But I had to kind of take that first step. If you're running a business, utilize the tools that are here, like make these, you know, reach out to these folks.
Ramon, I think that's a great example, and I appreciate those comments, because again, it's the same echo I have with a number of MDs I talk to. And again, it's your decision, it's your play, but I hear all the time, well, I don't want to be in debt, and it's a badge of honor about being in debt. I come from the opposite school, okay? I want to use somebody else's money anytime I can, okay? Because at the end result is, if you believe in yourself and you're growing your business, then the end result of that is you're going to cover that. You know, you take a risk and by taking a more expensive car loan on a vehicle that's depreciating as soon as you drive it out of the lot. Well, why don't you take the same risk with yourself, saying, I can make this business work, and take out some loans and help you grow and not have those types of headaches? Because believe me, you don't. And it's an interesting point you bring up, because you know, we were part of a large company, so I was dealing with large corporations. To your point, I had vendors taking me to 60, 90, 120 day payment terms. Okay? Most small business owners cannot manage cash flow for 120 days, right? And again, having a good accountant, as we talked about, right? That's the person that sits down and does a 13-week cash flow statement for you and religiously updates it every week, right? Because they can look out 7 weeks out and say, hey, we got an issue out here in 7 weeks. We're not going to be able to make payroll, right? So what can I do in the next 7 weeks to make sure I have the cash? And there are a lot of things you can do. You can look at your own payables. For example, if you're, you know, saying, I always want to pay my vendors on time. I want to pay them in 30 days. And that's great. But if the other guys are paying you 190 or 120, something's got to give there, right? So you have to go back to them and say, you know, I need to take you to 45. So all of a sudden you change that cash flow model to 45 days, and now you've got the money to pay the payroll in 7 weeks. So again, this financial side is so important, and I think as we progress it. So tell you what, let's stop there. We had a couple, Ramon had a very good point. Any other questions we can answer from the group now? Sion.
One question, just piggybacking on what you just said, Gary. Do you look for, you know, paying your vendors later, right, to sort of balance your cash flow? Do you look at D&Bs at all, or is it just for lending? Do you look at companies that's done Bradstreet, the company's D&B?
Any of you? Is that a place to start with?
Can you repeat
Can
the
you
question?
repeat
Sure. So Gary had mentioned sort of.
Were you talking about the vendors?
The vendors.
Oh, my bad, yeah.
Balancing your cash.
Yes,
flow.
I know, I did.
Yeah, right.
I absolutely
Balancing your
did.
cash flow by paying your vendors late.
Right.
That's a ding on your D&B, your Dun & Bradstreet, your
Right.
business credit report. Do you use that in your credit decisions?
So you brought up so many great points, right? As a business owner from start to 5 years, and you know, it's important to have a relationship with an accountant, but it's even more important to have a relationship with your bank, whatever bank that is. You know, it's our bank's obligation to our clients to truly understand what stage of the business your business is in. And so when we think about some things that, as you spoke, came to my mind is invoicing, right? Every bank has a way to help support. How can we speed up that invoicing? What tools and resources does my bank have? And you know, truth, the larger the bank, the more different tools and resources we will have, you know, to help support that in your business. So, you know, if your invoice sometimes with larger businesses is taking up to 60 days, we'll go to your bank, because your bank may have a way of speeding that up, whether it be electronically, you know, there's so many different ways to do so. You know, and then thinking about how to manage money. You know, I'm gonna point out Bank of America, we have a great platform through our business, small business called Business 360. And it actually projects based off of, and it's a free platform where you know, many small businesses that I'm looking at here are investing money in these different apps and ways to know who are my competitors, how can I project the future, how can I project tomorrow, where your bank may have, or you know, in our Business 360, it projects you out 6 weeks, 8 weeks, 12 weeks. So you already know how your business is going. Is it gonna be in the upward trend or the downward trend? And then I think about a little bit about debts. Every business owner is afraid of debt, but every business needs the debt because it helps out to your acronym DB, right, Dun and Bradstreet. So a little debt could simply be a business credit card, right? Showing that repayments, using it for working capital, using it to buy different supplies for the business and doing it on a monthly basis. It's gonna help your business score, and at the same time, while it won't ever be on your personal scores as well as growing debt, which a lot of business owners, they're afraid of the debt, but don't realize that anything you do under the business is gonna be completely separate from your personal. It'll never show on your personal debts, which is great because a lot of business owners, right, they're looking to buy a new home as their business grows. One of their personal goals is to buy a second home or a new home, and that's something where that business separation can play a major part in.
That's a good point. I think also for me personally, see on the DMB piece, depends on where your business is. Like for our case, we are capital intensive from the standpoint of equipment and assets. So that would have an impact when I was seeking another loan to buy another piece of equipment, right? But if you're in a business that is not doing that, I'm not sure it matters much. Just the same as we get older, do you care as much about what your financial score is, what they call FICO score, when you're older, because you're not planning on taking on any more debt, right? So if you do certain things. So I think it's something you have to weigh. And you can't do that to every vendor. We never did it to every vendor, but there were certain key vendors that we would extend in that case if we had to. You know.
And my question was, does it factor into your credit decision?
Yeah,
Someone's business credit score, the DMV score.
right.
I don't think we really look at a DMV score for the most part. Because we're institutional investors, I mean, we're looking more at, we don't even really look at tax returns. We look at financial statements, right? We want to see spreads. We want to see the detail. We want to see line items of the income statement, the balance sheet. We're going to look at, the current assets and the current liabilities. We're going to look at your AR and your AP report, right? So we'll make some determinations. And that really kind of gets into kind of your business model. Is it a business model that we feel comfortable with? I mean, if you're, like you said, if you have clients that it takes them 90 to 120 days to pay you, well, yeah, you're going to have some pretty long, payment terms for your AP. It just kind of, it kind of makes sense. But, if you're getting paid every week or every month, then that's going to be more in line. So it kind of depends on, the business model and industry that you're in as well. And then from there, if we're okay with the whole industry, then we'll probably be okay with